What is corporate-owned life insurance? Simply put, it's a whole life insurance policy that sits inside your corporation instead of being owned personally. Your company pays the premium, the cash value grows tax-free inside the corp, and when you need to access that money, you borrow against it instead of withdrawing. That means no personal tax triggered. Think of it like a high-interest, tax-free savings account inside your corporation. One that you can access whenever you want without giving a chunk of it to the CRA. It can also provide a death benefit, creditor protection, and it's not affected by the stock market or the economy. When it's designed properly, it's one of the most powerful wealth building tools available to corporate business owners. How does this actually work? Here's the simple version. You fund a properly designed whole life policy inside your corporation using retained earnings. The cash value grows tax-free year after year. It never goes down. It's completely protected from the stock market volatility. Now, when you want to access that money, you don't withdraw it. That would trigger tax. Instead, you borrow against it. You use the policy as collateral and set up a line of credit. You get access to your money without paying personal tax on it. And the policy keeps on growing in the background. It's like getting access to your money tax-free while it continues to compound. That's the power of a properly designed policy. What's the return on this? Good question. And it's important to think about this the right way. This isn't like the stock market where you're chasing returns and hoping for the best. A properly designed whole life policy gives you steady compounding growth. Currently around 4% or more, tax-free. Now that might not sound exciting compared to what you hear about stocks or crypto. But here's what most people forget. It's not about how much you make, it's about how much you can keep. When you factor in that this growth is tax-free, protected from creditors, not affected by the market, and accessible without triggering personal tax, it often outperforms most traditional investments over the long term, with significantly less risk, where you can actually sleep at night. Why haven't I heard of this before? There's a few reasons. First, where do most Canadians get their financial advice? The banks. And the banks only offer this kind of strategy for their ultra high net worth private banking clients, not regular business owners. Second, most financial advisors are to sell mutual funds and term insurance. It's easier. It's what the masses understand. Whole life takes a little more work to explain. Third, and this is a big one, most advisors don't actually understand how to design a whole life policy properly. When it's designed wrong, it's expensive, inflexible, and benefits the advisor more than the owner. And that's where whole life gets its bad reputation. But when designed right, it's a completely different product. That's why you need to work with someone who specializes in this. Isn't whole life insurance a bad investment? I hear this all the time, and honestly, some of the time, it's true. Most whole life policies are bad investments, and here's why. There are two ways to design a whole life policy. One way is expensive, inflexible, and benefits the advisor. High commissions, low cash value, and that's what most people get sold. The other way is low cost insurance, high cash value, and built to benefit the owner. That's what I design. Same product, completely different outcome. So when someone says whole life insurance is a scam or a bad investment, they're usually right about the first type. But a properly designed policy, that's a different conversation entirely. How much does it cost? Let me ask you something first. Do you consider insurance an asset or an expense? If you see it as an expense, I get it. Most policies are designed that way. But the policies I design are different. Yes, there's a premium. The cost of insurance has to be covered. But I design policies to be flexible with low insurance costs and high cash value. Over the time, the policy becomes more and more efficient. The growth compounds, and eventually the cash value can cover the premiums itself. At that point, it's not costing you money, it's making you money. So the real question isn't how much it costs, it's how much it is costing you not having one.